Welcome to the Money is Emotional podcast with Christine Lukin, the financial dignity coach. In this podcast, we help you recover a positive and peaceful relationship with your personal finances. We do this by bringing together wise money management with emotional intelligence. Join us for this journey where we navigate our relationship with money as Christine Lukin draws from years of experience and guest experts to help you get to the root of your money issues.
Hello, my friend. Welcome to the Money is Emotional podcast. I am your host, Christine Lukin. Today's episode is how to not freak out when the markets go crazy. I'm honored to welcome today's special guest, Akash Kanojia. He is a finance professor at UT Austin and a former bond investor with over 15 years of experience on Wall Street, including stints at McKinsey and the Federal Reserve. He teaches money and capital markets and writes about how emotions like shame, scarcity, and status anxiety shape our financial decisions. Akash has helped investors, students, and founders understand the deeper emotional drivers behind procrastination, risk aversion, and financial self-sabotage. His work sits at the intersection of financial systems and human psychology, exploring why smart people sometimes make irrational money choices and how emotional intelligence can unlock better outcomes. You can find his writing on his website, which we have linked up in the show notes. Welcome, Akash.
Thank you, Christine.
Well, let us start at the beginning. Tell us briefly about your journey from bond investor on Wall Street to becoming a professor, teaching students about money, investing, and emotions.
Yeah, so and I'll weave in the emotional dimension of this as well, but I quit my job at the Federal Reserve in 2021 to try my hand at entrepreneurship. I started 2 companies. I've not been successful. So I moved to Austin also in 2021, and one of my old finance professors said that, hey, and this was after my second company went nowhere. He said that, hey, if you're not doing anything, the department's always looking for adjuncts. So if you're interested, I'll make a connection to you and the department chair. So we met for lunch, and he was like, yeah, do you want to, until you figure out what you do when you want to do when you grow up, do you want to come and babysit undergraduates? And I said, sure. So it's that's what I'm doing now. I was an adjunct at NYU before, but that was 100% a side gig.
Yeah. Well, it's refreshing that you admit I've tried entrepreneurship, and so far things haven't worked out because, I mean, most people would just like sweep that under the rug and not even talk about that because there can be shame about that. But I think if most entrepreneurs are honest, they will tell you that they have tried multiple things before they actually found the thing. Yeah. So you say that every market crash is an emotional story. Can you unpack that for us? Like, what's really happening emotionally when the market drops, and how can investors separate facts from emotional noise?
Yeah, so I love the question. Thank you, Christine, because this is at the center of what I personally am trying to understand for myself. So my hypothesis is that markets, countries, nations are systems that are composed of building blocks, which are people. Yeah. And our decisions as individual people, the subcomponents of those are our feelings, our emotional states. Nobody takes an action without some kind of emotional urge underneath it.
Yes.
And so whenever we have a big macro cycle, like a speculative boom or a crash or a sustained market depression, that is the product of millions of people making individual economic decisions, which are based on their individual emotional states. Yeah. So from my viewpoint as a macro investor, in order to understand how those market cycles work, I have to understand the building blocks of how people feel. Mm-hmm. And I want to try to understand that and the connection between those two things at a deep level. So that's my high level take on this.
Yeah, I love that. So let's talk about when the market drops, because I think this is when people get the most emotional. And,
Yep.
You and I chatted last week just to get to know each other.
Yep.
And I told you, I said, I have had people in my life who are very smart, very level-headed, and I've had to talk some of them literally off the ledge of cashing out their entire retirement account because they were fearful of election outcomes, or they were fearful of what's going on in the economy or what's going on with the government right now. And, there was in the bigger picture of things, it's like, well, it's not like the US stock market is closing their doors and going away. Like, where is this coming from?
Yeah, so the one observation that I want to make is that the feeling of panic and fear is ever present. So that feeling itself never goes away, even for the most veteran, sophisticated investors.
Yeah.
There's an investor I like named Stan Druckenmiller, and he doesn't speak often, but if you go back and read some of his speeches, you'll see he's describing his emotional states as things are turning topsy-turvy, his trades are going against him, etc. And what veteran investors are able to do is that they're able to accept that those emotions are going to happen, and they don't react to the emotions. They remain proactive.
Yeah.
And I'll share with you a personal mistake that I made in this, and we'll get to this, like establishing systems, but my very first trade as a macro investor, I lost $750,000. So basically,
Oh my God.
it's not losing the money. So it's basically what happened is I was on a team of portfolio managers. I had a view on what the Federal Reserve was going to do at a meeting. So we put on a curve twist trade that we thought the yield curve would turn in a certain direction. So this was my idea. I pitched it to my colleagues. They liked it. We pitched it to the CIO at the investment committee meeting. He was on board. So I did a write-up on the trade. It's a 2-page document about here's the thesis behind the trade. Here's the entry level. Here's how much risk capital we're going to put in. Here's where we're going to exit if the trade goes well. Here's where we're going to exit if the trade goes poorly. So first day, the Fed meeting happens. The trade does not do well. And our document said, which I'd written, was if we lose a certain amount of money, we're going to cut our losses and get out of the trade.
Yeah.
Now, this is where I went wrong. So I still believed in the trade. So I told my colleagues, guys, I still like this trade. I think we should stay in it. My colleagues agreed. We went to the CIO. He was like, okay, you can stay in the trade. Next 2 days, the trade continues to go against us. So we could have gotten out at a $250K loss.
Wow.
But then it was $750. And then the CIO was pissed. He was like, you wrote this document. You're getting out of the trade now.
Yeah.
And so at that point, and he was not angry with me for losing money. He was angry with me for not failing to follow my own discipline.
Mm.
And so my emotions hijacked, because this was my first trade. My ego was involved. I want a reputation as this great portfolio manager with amazing instincts, and I'm really smart, and I show up, and on day one, I'm just printing money. Like, I had all that stuff in my head. And so it doesn't work, which is fine. In finance, most of our trades don't work, but the good investors are the ones that have the discipline to stick with their long-term plan, whatever it is.
Yeah.
Because the reason we have the plans is to protect. We know these emotions are really strong in the moment.
Right.
And again, my boss was not mad at me for losing money. He said, I want you to do 10 times as many trades. Because he believes in my intelligence, even though one trade being wrong, intelligence like ability, he trusts me as a portfolio manager. But he's like, the lesson here is that you need to be disciplined.
Yeah. Follow the plan.
Yeah.
Yeah. And so I could see how, it's like your ego was saying, no, this wasn't supposed to happen. Like, I need to stick with this decision, right? It's that I know there's a term for that, and it's escaping me right now. I think it has
Stubbornness.
no, I think it has to do with like sunk costs. Like you
Yeah,
are
yeah.
more invested in something that you have sunk real money into that you will double down on it, um, versus getting out and saying, I was wrong.
Yeah, so that hurt. I mean, that was literally what I wrote about last Friday was just the reason investing is so hard is because we are wrong, and we're not just wrong, we're like super wrong, and it hurts super bad.
Yeah. Yes. Yeah. Well, I'm sure you have read I think it's The Psychology of Money. Yeah, Morgan Housel, and he talks about how many times you're wrong versus when you're right. And just like knowing that you're going to be wrong, and you can still be wrong a big chunk of the time and still do well with investing.
Yeah.
And reading that was like, oh, okay, it's okay to be wrong. It was like a relief to read that
Yeah.
and to hear that. So I want to talk about like the herd mentality. You know, yes, we can feel our own fear when we see the market going down, but then you get the media and then you get opinions from the people around you, and that can really amplify that fear. And so, are there some practical steps that you would recommend investors take to avoid those knee-jerk decisions, especially when everybody around you is catastrophizing, but you still want to stick to your plan?
Yeah, so there's a saying, and I don't know where it comes from. It's we rise to the level of our willpower and we fall to the level of our systems.
Mm,
So as individual investors, we just so the general when people are like, well, what should I invest in? Do you like the stock, etc.? My general view on this is that if it's not my main area of work, I would rather just diversify and pick baskets of things. And the
yeah,
reason I say that is because in order to be good, anybody can be good. You just have to invest a lot of time to beat professional traders on Wall Street who have armies of analysts and supercomputers running cutting edge AI models. If
yeah,
you think you can beat that as a hobby, go for it. But to me, that represents extreme arrogance that you think that you can do better than them with
yeah.
5% of the resources.
Hmm.
I would rather, and this is what I tell all my students, I would rather, if you want to be wealthy, focus on your top line.
Yeah,
So rather than spending 15 hours a month studying investments, if I'm not, I mean, you need to know the basics. But rather than
yes,
like, unless it's fun for you, if it's fun for you to go research Apple, then it's no longer investing. It's a hobby.
right.
Like if it's fun, do things that are fun. But if you're doing it because you want to increase your returns and you're not prepared to commit to it because you want to have a stronger financial foundation, I would rather you take those 15 hours and figure out how to be better at your job.
Mm,
So if
yeah,
you're a software engineer, be a better software engineer so you can get promoted and make more income to invest and just invest that passively. So it's really like we have a limited amount of cognitive ability in a week.
hmm,
Where do you want to spend that? I would spend that on the places that have the highest returns, which is doubling down on the thing I'm already good at. Now,
yeah,
if we don't understand the basics of investing at all, that means the returns there are negative. So we need to invest some time to just not make the most basic mistakes, which is like not investing at all.
right. Yeah,
But if that is the attitude that we have, then we take a basic system that works for most people. We play that system and we're like, okay, fine. If the market went down 20% this year, and it's like that's a nasty move in the market.
yeah,
if I instead spent that time figuring out how to increase my income 20%, well, that income continues to compound because I will
Yeah.
be working every year and I'll be investing more money every year. So it's just like,
Hmm.
let's think big picture about what is the most efficient use of my time and limited mental energy.
Yeah. No, I love that. No, I love that. And just, getting the basic investing education. And there's so much information out there. And there's one book that we read in the Wealthy Woman Book Club together called Girls That Invest. And I have been recommending that to both men and women because I feel like it is such a good, straightforward book about the basics of investing.
Yep.
And once you understand that, then you can make that decision of, do I want to hire someone to help me do this? Do I want to just do a passive investment strategy and, invest in the S&P 500 and different EFTs and mutual funds, etc. But then that really gives you the power to say, okay, this is how I want to do it. And for me, it was interesting because we did this experiment as part of the Wealthy Woman Book Club where we used Investopedia's simulator. And so it starts you with like, I don't know, 100 or $150,000. And so we basically had 3 months. And I said, okay, we're all starting. You've got to do a screenshot of all your stock picks. You can't have more than 10% in cash. By this date, we're going to run this for 90 days. Whoever has the highest balance at the end of 90 days, you're going to get a $100 cash prize. So here's what I learned. I don't like doing this for myself.
Yeah.
I
Yeah.
learned that the money that I spend with my financial planner is money very well spent because I don't have to spend the time looking at things or worrying about things. I let him do that.
Yep.
But then there's other women who found that they really enjoyed it. They enjoyed researching the stocks and the different funds and the investments once they knew how to do it. So yeah, it was a lot of fun.
Yeah. And so I love that because we only have one life on this planet.
Yeah.
Let's over index on the things that we like to do. If they
Yeah.
just don't come at the detriment of physical, emotional, mental, financial health.
Yeah.
So let's get our health figured out and then let's go have fun. So if investing's fun, by all means do it.
Yeah.
I actually like to tell people if there's an industry that you're passionate about, this is more for my students who are finance majors, but sometimes they major in finance because it's a good career
Mm-hmm.
and they're not actually interested in the material. And that's fine. I mean, we all will ultimately end up where we need to be.
Yeah.
And so they're like, how do I get interested in finance? How do I cultivate that passion? And maybe they'll never be passionate. I just say that, okay, well, is there any industry that you're super interested in? So for example, I had one woman come in and she's very into fashion. I was like, can you be the ultimate fashion person? So not only do you understand the dresses or the shirts or like whatever fashion people do, the textiles, can you also understand the entire business of the industry? So can you
Yeah.
understand the supply chains? Can you understand how tariffs impact? Can you study the different companies on their financials?
Yeah.
And so can you be this fully integrated fashion person where not only are you following the parts that you're really excited about, but you understand the business layers underneath that?
Yeah.
And that might be a way to cultivate that excitement. So some people, that works for them. So they're like, okay, 80% of my portfolio, I'm going to have passive, but I'm really into sustainability. So this 20%, I'm treating that as Vegas money. I'm not expecting to beat the market,
Yeah.
but I'm going to be an expert on sustainability. And it works. My finance, I get to learn. I build confidence because I mastered something difficult. I'm learning more about the industry I really care about, which might be my day job or it might be an industry I want to transition into.
Yeah. No, I love that so much. Um, because if you're interested in something, then learning the financial piece that relates to that and how those two things interact can actually be fun.
Yep.
For me, I'm not a finance major. I'm an accounting major.
Yep.
And sitting around doing accounting doesn't that's not exactly what I'm passionate about. But what I realized was in any industry, accounting is needed. And basically, accounting is being efficient with your money.
Yep.
And so when I worked full time in accounting, I started out I worked for an interior decorator. And so being in that industry was fun. And I learned a lot about interior decorating while I was crunching the numbers. And then I moved into manufacturing. And for me, it was I got to learn about this whole new industry. But where my joy came from was being efficient with the numbers and finding the story behind the numbers, which is now exactly what I do for my financial coaching clients. It's getting in there and figuring out, almost treating the family finances like a business to say, where are we being profitable? Where are we being wasteful? And all of that good stuff. So I really love that.
Dare to enter the Wealthy Woman Book Club, where answers exist to forbidden questions, where women of all ages and income secretly gather, where knowledge is shared, where possibilities are explored, where women claim their power. Dare to stay a spell in the Wealthy Woman Book Club. In this place, we lift each other up. In this place, we start dreaming again. In this place, we see financial miracles. In this place, we grow through the glory and the failure. In this place, we step into a new identity. Dare to champion the Wealthy Woman Book Club. We're creating a future where women are financially empowered across the globe. We're creating a future where our daughters stand on equal financial footing with our sons. We're creating a future where we purchase with our principles rather than price tags. We're creating a future where we use the power of money for the benefit of people and the planet. Welcome to the Wealthy Woman Book Club. Dare to come in, woman. Come in. Join us at wealthywomanbookclub.com.
So we've talked about fear. Let's discuss the other F word, which is FOMO. When certain investment classes, let's say crypto, AI stocks, are booming, it's hard to not feel like you're missing out. So how do you help people resist jumping on a trend that maybe it doesn't align with their long-term goals?
Same way as the panic, this feeling will exist. This has always existed in all market cycles. It's something that so there are investing strategies that are based on trend following.
Yeah.
So and there's hedge funds that do this. So if you want to, and it can be a profitable strategy, but again, it's this is what we put in the investment document at the beginning. This is the strategy. We're unattached to it emotionally. And if it doesn't work, we're just going to cut it.
Yeah.
That is different from, again, reacting to this emotion of, it's not peer pressure, but it's this feeling of, there's nothing that pisses off a person more or makes them feel worse than their neighbor buying a new car. Because that triggers all these insecurities and feelings of inadequacy and all that kind of stuff. And that is basically what is at play when we're talking about FOMO.
Yeah.
FOMO exists in many other areas of life too. So it's somebody else went on a boat party and I didn't get to go. And what did I miss out on? Now, there's deep emotional work on that.
Yeah.
Which is, there's work around acceptance and being comfortable with exactly who I am and being exactly in the present. The only thing I'll say in terms of market FOMO is that as a historian, of market cycle, or as a student of market history and market cycles, these things happen. There was FOMO with the tulip mania in the
Yes.
Netherlands. And so that's how these bubbles form, and they always end in tears. So the hard thing to figure out is this a bubble, or is this really a macroeconomic trend? And again, I
Right.
think this is where it comes back down to systems.
Mm-hmm.
So there are systems where we do investments very mechanically based on valuations.
Yes.
So if, again, you this is maybe something that you might want to talk to a financial advisor about. Again, with financial advisors, you just have to be careful because there are some that have a fiduciary duty to the client and some that don't.
Yeah.
And I don't trust the latter.
Yeah.
Because their incentives are not aligned to yours.
Yeah.
But I mean, this again, it comes back to following your system. So I wouldn't, just because AI stocks are booming. This is why diversification is good, because if AI stocks are booming and you're invested in the broad US market, you already have some exposure. So you're getting something, and that like helps us feel less bad. But there's nothing that's going to make that feeling of they bought a Ferrari next door and I'm still buying or driving my Volkswagen Beetle from
right, because they bought NVIDIA stock at, when it was couple bucks.
Yeah. And so I'll offer a personal story on this. This feeling of comparison never goes away. So I had a classmate in law school, and he went to become a lawyer and then later became an entrepreneur. And when I started my entrepreneurial journey, I reached out to him and I said, "Hey, Eric, can we connect? I'm thinking about starting a company." The first clue for me was that his secretary wrote me back and she said, "Eric can meet with you 4 months from now."
Oh, wow.
And so then I had this meeting with Eric. Thankfully, I always research people before I have a meeting. Turns out he sold a piece of his startup to a private equity firm for $1.4 billion with a B.
Holy Moses.
And so I love this story, and my students love this story, because this comparison never ends. It doesn't matter how much success we have. There's always somebody that is like 100x better than we are.
Yeah.
And again, this is accepting the reality of this world that we live in. And it doesn't, I'll have a 1.4 billion exit, and then somebody will introduce me to Elon Musk, who has like $400 billion.
Right.
So it's like it just never stops.
Yeah. Yeah. No, I love that, because I think, and I've heard the quote, I'm not in competition with anyone else other than who I was yesterday, and that's, we want to continuously get better ourselves. But if we're constantly comparing ourselves, we are either judging people's successes or failures and making ourselves either feel better or feel worse, depending on the comparison. Yes. Well, and I like that you made the distinction of, is this a fad type trend, or is this a shift in the marketplace? When we're talking about, AI in general, not about a particular AI stock, like, we know that this is going to change the way we live and work and do business. It's going to become a part of life, period. Like, this is this is not a trend. This is not a flash in the pan trend that we're gonna stop. But that is different from, stock picking or like even something like the whole GameStop thing, where it was like people just decided, like, okay, because Wall Street is shorting this stock, we're going to screw Wall Street and we're just going to start buying it. And then all of a sudden people jump on this bandwagon, and the few people that kind of started that trend, they're the ones that really made out well. Because they got out before things crashed. But then it's like the rest of the people are left holding this overpriced thing that there really wasn't much backing it up. So there is that you have to have that wisdom and discernment to say, is this something that is going to be around for a while? And sometimes you don't know. I mean, like with crypto, 7-8 years ago, people were like, this is a scam, right? Well, hasn't gone anywhere yet. So, so sometimes you just don't know. But being in that, the broad market indexes, that allows you to have exposure to a lot of different industries.
Yeah.
So I want to ask you this. So traditionally, we're told buy and hold, just ride out the dips. But what are the signs that your investment strategy actually might need to change versus weathering the storm? How can we tell the difference between like natural volatility versus a plan that needs to be changed?
Yeah, so the plan that needs to be changed is directly linked to your future liabilities.
Okay. Explain that.
Yes. So what most people are trying to solve for in investing is retirement.
Mm-hmm.
That's generally.
Yes.
So if your anticipated needs in retirement change, then your investment plan needs to change.
Okay.
So, and generally in my view, we ought to be focused on survival first. So I'm a CFA charter holder.
Okay.
And this is CFA level 3 focuses heavily on this. And I agree with the methodology. So I'm solving for how am I going to live between age 65 and age 95.
Mm-hmm.
And I'm not trying to necessarily maximize every last dollar that I'm getting out of the market. I'm trying to minimize the chance that I will be homeless when I'm 80.
Yeah.
And those are two different things.
That's true.
So, for example, if I have a child that is special needs, and now I'm anticipating I'm actually going to be a lifelong caregiver for this child, that shifts my future investment needs. And it's the answer is not like I need to go do riskier and riskier investments to try to jump over that hurdle. The answer there is I need to radically re-examine my lifestyle today. And I need to be just investing much more money and maybe in actually lower risk stuff.
Yeah.
Because this person is depending on me. It doesn't matter if we eat steak or we eat ramen, but we need to be able to eat.
Yeah.
So that's like very classic CFA level 3 thinking. It's like we're solving for these future cash outflows.
Yeah.
And we're back solving for that to the present.
Mm-hmm.
And this is where it gets scary for people, because when people are I've had students before. I used to teach this independent finance class where it's just finance 101 for ordinary people. So I had yoga teachers, surf instructors, sound healers, therapists, a lot of people from, call it like the more right-brained, creative or healing relational type professions, who not traders and accountants like me and you.
Right.
And some of them, there was a woman who's 55 and she has not been investing much. And she's like, how do I get to $3 million of retirement income in the next 10 years? So like, that's just not possible.
Yeah.
That's not, so now she has to accept that reality.
Yeah.
And so now what can she solve for?
Yeah.
And I don't know, but it's probably like a drastic reduction in lifestyle today.
Yeah.
Because this is like the ant and the grasshopper. It's like you have to save starting earlier if you want time value money to work for you.
Yeah. Well, I always tell people, invest early, invest often. I mean, if I could take every 20-year-old and just shake them and be like, do you know the opportunity you have in front of you right now? Even $100 a month, $100 a week. Like, if you start when you're 20, it's inevitable that if you're investing and you don't touch it and you don't do anything grossly stupid, you will have enough money in retirement if you start that early. You've written about scarcity mindset, blocking abundance. So how do you balance these emotional money patterns of not being super pessimistic and having a scarcity mindset, but also being pessimistic enough to protect yourself from the worst case scenario and having enough money to retire.
Yeah. So when it comes to scarcity mindset and investment opportunities, I feel like Warren Buffett and the way that he looks at investing is a great place to start. For him, the number one virtue in investing is patience.
Mm.
And so when somebody comes to us, so people often talk to me about private investments. So can I invest in my friend's restaurant or their food truck or their new business that they're starting, et cetera? And there's an emotional feeling of loyalty sometimes that we have to these people, and that can override other emotions relating to caution or judgment that we have. Like if my friend who wants to open a restaurant and I know that she's a hot mess,
Yeah.
and I love her, but I don't trust her as an operator to like get the blocking and tackling done, I have to say no to that. And that's hard.
Yeah.
What Warren Buffett would say is that, or let's say I meet somebody at a startup event and they're very good at sales, very good at pitching, dazzling, like many people in the space are. There's very little substance sometimes underneath all the claims that they're making. Warren Buffett would say, we're waiting for the fat pitch. That's a baseball analogy. So he's willing to like let the pitcher throw lots and lots of pitches until he sees the perfect one where he can hit it and it's a home run.
Yeah.
And so the scarcity mindset in this sense can manifest as somebody comes to us with an investment opportunity. We think that's the only one out there. So we feel like we have to jump on it. Or this is like the only exciting person that we think is a good entrepreneur. Well, no. I mean, that requires patience and it requires homework, which are things that as impulsive people, like we don't want to do that. So the impulse is the emotion that we are accepting and recognizing that our system is one that is going to protect us from that. So it might be that anytime somebody comes to me with a private investment decision, I already have a list of 15 questions that I'm going to ask. And I'm going to ask them, where's your due diligence? So for my friend, I'll ask her, can you send me the financial model of this restaurant and where you expect to make break even? How do you make the budget? And she's like, I don't have one, for example. That's like an immediate no, because the first question is, has the entrepreneur prepared proper financial projections? If the answer is no, then I know that this is just not an entrepreneur I can trust.
Yeah, for
and
sure.
I will wait and wait and wait until I meet somebody that meets all 15 of my criteria. And I'll give you an example of this. So I did make an angel investment, I think back in 2018, where it was based on a 15-minute meeting.
Okay.
My buddy Federico was in New York. He was like, hey, we haven't talked in a couple of years. Do you want to get coffee? So we met up and he said, hey, I quit my job. He was actually also at a law firm. Quit my job. I'm starting a company. And he was telling me about the company. And what I realized, I have been reading about startups and investing for so long. I had this mental checklist already. It was subconscious. And as Federico's talking, it's like green flag, green flag, green flag, green flag. And at the end of it, I told him, hey, can I invest in this? Can you find me a clip? Because he was, I think, raising 300K at the moment as like early seed. And he said, sure, if you can wire me 25K by Friday. So like no documents, didn't sign anything, no contract. He just gave me a bank account and I sent him 25 grand. That investment, I mean, that company in 2022 was valued at 104 million.
Wow.
And so like I'm up a lot on that. I mean, it's still privately held. They're raising their Series B this probably right now.
Yeah.
But that was a case in which I had this mental checklist and I saw subconsciously, emotionally, what felt like a fat pitch. I was like, I know Federico, I trust him. So that's like one of those things is, do I know this person? Will they screw me? I know he won't, because for this amount of money, you're not going to, at least the kind of people that I want to be friends with, they're not going to jeopardize a lifelong friendship for something like this.
Yeah.
If this business fails, he'll come back to me for another investment.
Right. Yeah.
And so it was just a bunch of yeses. Whereas like there's many other investments that I've said no to. Like I see it and I like it might be a good investment, but one of the lists is do I understand this business? If I don't
That's important.
understand the business, then I'm just like, no matter how exciting they make it sound. So that's like investment opportunities are not scarce. There's many out there. And I'll just wait until one comes along and fits my criteria. And Warren Buffett at one time was the second richest person in the world. He had a 50, 60-year investing career doing this.
Yeah. Yeah. Well, and I think that's important, just understanding what you're investing in. Um, and it doesn't all have to be in the stock market, too. That's what I tell people. That's one of the reasons why I love my financial planner, because he's like, yeah, I love it that you own real estate, that you own precious metals. He's like, you don't have to have all your money with me, and I wouldn't expect you to.
No. Yeah.
Which tells me that's somebody that I can trust, because I've had other financial planners where it's like, as soon as you have an influx of money, it's like all they can see is how do I get my hands on managing that so I can get another chunk of it.
Yep.
So if someone's listening right now and they're feeling anxious about the market or their retirement accounts, but they do have a plan, like what's the one thing you want them to hear, maybe that they should even write on a sticky note so they can stay centered and confident and committed to their plan?
Yeah. So my first reaction to this, Christine, is that the anxiety is going to come. Anxiety, fear, these are basic emotional states that most of us feel very frequently. So accepting that fear is going to be there, to me, is step number one. The other thing is that when our worst fears never come true. And this is not even just relating to investing, but anything that we're doing. So let's take social anxiety, for example. So since I teach undergraduates, some of my students at age 21, 22 were not fully developed humans.
True.
So some of them are anxious in certain types of social situations. And they have a fear that, okay, I'm going to look stupid or people are going to judge me, et cetera, et cetera. That like never happens. People that are anxious at parties, everybody is focused on how they look to other people. Nobody's thinking about you at all. And just recognizing that fear state is completely normal, and that our worst fear of people are noticing that my shirt is torn somewhere, like here on this part of the collar, and then they're going to think I'm stupid. Like nobody's noticing that fear isn't going to come to pass.
Yeah.
So to the extent that we can map what's happening in the market and our emotional reaction to that to other domains of our life and say, okay, this is the same emotional pattern that I feel in a social setting, or I feel when I'm with my romantic partner or whatever, and it's just the same thing and it always comes out fine in the end. That is maybe the first thing that I would invite somebody to do. And then the second thing is to just, again, we need to think about what is the problem that we're solving for. So if it's for my retirement, so for example, my uncle is in retirement, and he decided, because he can't tolerate, his risk tolerance for these market swings is just really low. He's like, I get really stressed out. So he made a conscious decision to cut risk.
Yeah.
So when he was in his early 60s, he's like, I just can't handle this. I'm okay with lower investment returns in exchange for this emotional piece. And he's like, I have enough to meet my needs. My needs are modest. So I'm not going to try to be greedy. I just want to be able to sleep at night.
Yeah.
I'm kind of the opposite, where I quit my job cold turkey in 21 to try to start a company with like no income, no guarantee of anything. My risk tolerance is extremely high. So a big part of that is just knowing, what are we wired for?
Yeah.
Because ultimately, the only thing all of us are looking for is happiness, contentment, meaning, being present, the relationships, all that kind of stuff. Money is just a foundation underneath that.
Yeah. Yeah. Well, it's like I say this all the time. Money's job is to support your happiness, not to be the source of it.
So let's solve for our happiness first. And that's not, some people engage in hedonism, and that's actually avoidance of, I'm going to spend every last dollar I have because the financial reality is so scary, I don't want to look at it. That also happens a lot with people.
Yeah.
And that just makes the problem. We all know that when any problem that we avoid, it just gets worse while we don't look at it.
I was gonna say it's not gonna solve itself.
No. And that's a very different emotional challenge. But like when we're grounded and present in the storm of the fear, the scarcity, the shame, the regret, all that kind of stuff, we absorb all that stuff. We let ourselves feel it. We let ourselves process it. Then we can start to make conscious actions.
Yeah.
So like, what really matters to me in my life?
Awesome. Well, Akash, thank you so much for coming onto the podcast and sharing your expertise to help us keep cool heads while investing our money. We're going to have all of your links in the show notes so people can find your website. They can find you on social media. Well, my friend, this is where I leave you for today. If you enjoyed this conversation, please leave us a review. It helps others to find the Money is Emotional podcast. And if you're not a subscriber yet, what are you waiting for? Hit the subscribe button and you'll be notified when a new episode drops. Until next time, this is Christine Luken reminding you that you're good enough, you're smart enough, and gosh darn it, people love you, including me. Bye for now.
Thank you for listening to the Money is Emotional podcast. To get in touch, visit our website at www.christineluken.com or drop us a line at hello@christineluken.com. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Christine Luken. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing or tax advice. Always seek the advice of your advisor, tax professional, or other qualified financial professional with any questions you may have regarding your personal finances.